Michael Burry, who is an investor so well known for making big bucks during the 2009 financial crisis, is warning investors again, this time on inflation. Michael Burry became very well known to the public after a movie called The Big Short was released. The movie revolves around Michael Burry, played by actor Christian Bale, in the times leading up to the financial crisis, when Michael Burry realizes that the subprime real estate market was in danger of imploding. And by betting against this market through credit default swaps, he made his investors a lot of money. Between 2000 and 2008, Zion Capital, a hedge fund that Burry founded, made gains of over 489%, while the S&P 500 returned just over 3%. Before we dive into Michael Burry's tweets, let's talk about what inflation is real quick. Inflation is generally defined as the rise in the price of goods and services over time, and the most used metric of inflation is the Consumer Price Index, or CPI for short, which measures the average change over time in the prices of a basket of goods and services. And investors worry about high inflation because inflation can really eat away at your returns. Because even if you make a lot of money in stocks, if inflation is high, then everything you may want to buy with your gains will rise also. And over time, this really can eat away at your gains. For example, if you invested $100 in stocks back in 1928 and held until today, you would have over $500,000. But if you factor in inflation to your gains, the real value of that $100 would only be just a bit over $33,000. And this is why investors often call inflation the hidden tax. And there are two main causes of inflation. The first is large amounts of government spending and monetary policy in times of crises like the pandemic that we are suffering through right now. The second is economic growth as people spend more, and supply of products cannot meet demand, so prices of goods tend to rise. And Michael Burry is concerned about these things. In his tweets, he says the US government is inviting inflation with its MMT-tinged policies. MMT here refers to modern monetary theory, which in contrast to standard theory, says that the government doesn't need to borrow money to pay for things, because for countries like the US, the government can simply print more money as they need, since the government is the only one that can issue the currency. And as the next round of stimulus is injected into people's pockets, with demand for manufacturing showing a V-shaped recovery, Burry points to the PMI index, which is an index showing how purchasing managers view market conditions, and what this rebounding in the index tells us is that people that are in charge of manufacturing in the US are expecting a big rebound as lockdowns ease. These tweets have since been taken down from Michael Burry's Twitter account, which funnily goes by the name Cassandra, which is probably referring to the character in Greek mythology who only spoke true prophecies but was cursed to never be believed. And his Twitter bio says this in Vietnamese, which translates to, "No more, you know where I stand." But the Fed Chair Jerome Powell doesn't seem to be worried about inflation for now, saying that the economy has not fully recovered, and if the inflation rate does end up going higher, they have the tools to slow that down. So what can investors do to help protect their money from inflation? The most common answer you'll hear is just invest in stocks, because even if inflation rises, companies will just price their goods and services higher, so stock prices will rise together with inflation. Another traditional hedge against inflation is gold. Because the usability of gold does not vary much through the years, people like to invest in gold as a storehold of wealth. But recently, it seems that investors are favoring the new digital gold, namely Bitcoin, to become a replacement of gold with its limited supply and growing users and availability. But Michael Burry is apparently not a huge fan of Bitcoin because he is worried about governments putting harsh regulations in place for cryptocurrency. And real estate is also a common hedge against inflation, with real estate prices rising often more than the inflation rate. But the real estate market is a volatile market much like the stock market, and when inflation slows down, the inflated prices tend to fall more quickly than other prices. So overall, inflation is most likely going to rise in the coming months as businesses reopen and the economy recovers, but it's not a certainty that inflation will continue to rise, at an accelerating pace for the long term. But either way, it might be a good idea to consider adding some hedges against inflation in your portfolio if you haven't done so already. That's going to do it for this video. Please hit the subscribe and like button, and I will see you guys in the next one.